The property market is never far from newsreels in this country, and sensational headlines are run regardless of whether prices are rising or falling. Sometimes there's a distinct discrepancy between what we read and what's happening on the ground, and I often wonder about the power of the media to create market conditions. When they run a sustained campaign forecasting double-digit growth or decline, I suspect the impact on consumer sentiment could trigger a change in market behaviour. The Sydney property market is currently being reported as leading the downward spiral. Is it all doom and gloom, or is everything not quite as it seems?
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent, co-host of Foxtel's Location Australia, and author of Auction Ready.
And I'm Chris Bates, mortgage broker. Before we get started, I need to let you know that nothing we say on here can be taken as personal advice. We always recommend you engage the services of a professional.
Don't forget that you can access the transcript for this episode on the website, as well as download our free full or forecaster report, Which Experts Can You Trust to Get It Right? theelephantintheroom.com.au.
Today, we're going to have a discussion about the changing market and what's happening on the ground in Sydney. And even if you're not particularly interested in the Sydney property market, in this episode, we'll be covering a number of principles that will apply in other markets across the country. We've invited Matthew Hayson, real estate agent and co-founder of boutique agency CobdenHayson, to join us today. And it's been a while since we last spoke to him, officially anyway. He's was our third ever guest on the podcast back in 2018. Now, one thing that I like about Matthew is his willingness to drop the sales spiel, which you don't come across very often in this industry. He augments almost 3 decades in local real estate experience with high-level economic and financial knowledge, strategic thinking, and has developed a quite refreshing manner of reporting on the market. So we're looking forward to this discussion about what's making the property market tick at this time. Thanks so much for joining us, Matthew. Good to see you.
Pleasure. Likewise. Good to be here. And 4 years. Hopefully it's not another 4 years, right?
This will go forever. We love it, don't we, Chris?
Yeah, we're not going anywhere. And hopefully our listeners aren't either. So thanks for listening and thanks for coming on again, Matt. I mean, Veronica and I were chatting last week and, we were just sort of talking about our frustrations that we need to get an agent on we haven't had an agent on for a while. What are their buyers saying? What are different buyers at different price segments? What are they saying to their vendors? What are the vendors really doing over the next, 6, 12 months, etc. So thanks so much to come on. I mean, I wasn't going to start here, but it is my big pet hate for the last few months where from what I'm seeing from our clients, and the decisions they're making, what the options they've got on the table versus what, CoreLogic is saying in terms of price falls and what big market commentators are saying is a huge lag, right, from what you're seeing in different price segments. So what's your thoughts on the sort of data lag at the moment is around pricing and, how off it is, I mean, I guess, in from what you see?
Yeah, for sure. Well, look, I think a simple thing that a lot of people can probably feel they've got some leverage on or understanding of is when the market was hot last year, so a lot of agents, and we were kind of wrapped up into this as well, when the market was accelerating at such a pace, a lot of people were saying, oh my God, I went to this auction and they were quoting $2 million and it ended up selling for 2.5. How could the agent get it so wrong? How could this happen? And in some cases that was fair criticism. But what was actually unfolding at that time is what people didn't probably see is the market was increasing at some points 5, if not 8% per month. So when you would start a campaign, you would say to the client, look, the house is worth $2 million. By the time you were finishing the campaign or getting to market, it might have been worth 2.2. And midway through the campaign, it might have been worth 2.3. But what we're seeing now is the reverse of that is unfolding in the market. So, and it's human nature that we see and read into the data. So if the data is now telling us and the trend line is saying to us in the media headlines that the market's going to fall 20%, 25%, well, it's only human nature to factor that in before it actually occurs. So what we're seeing in the market at the present time is the media headlines are sensationalist. We're seeing it now, this week, every week in Sydney, I'm sure nationally, you're seeing a new headline, a new financial institution telling us what's going to happen or unfold in the market over the next 6 to 12 months. Last week, it was Barrenjoey, the financial investment bank Barrenjoey, saying that property prices are going to fall 25% in Sydney, nationally probably 20%. So as a result of that, it's pretty hard if you're a buyer to look at that and go, well, if I'm looking at a house that's worth $2 million, why don't I just offer them 1.8? So that's what we're seeing kind of unfold in the market at the moment. So it's very different from the fear of missing out. It's now the fear of overpaying. So the data, though, CoreLogic, I think nationally is saying it's down, 8% or something like that. But here on ground level, I can tell you in Sydney, for certain segments, we're seeing more like 15, maybe even 20% for those properties that we consider to be C-grade properties.
Yeah, I mean, up on the beaches, we saw it pretty quick, 15, even up to 20%, I would say, on some properties, in the space of a couple of months. And you've got big commentators coming out there and saying, oh, Sydney's down 3%. I said, well, you don't buy the Sydney market, right? You don't even buy the median, to be honest. You buy different price segments. And, and so I think that's the problem. We had a client this morning, and new client, very green, first home buyer, trying to buy a family home in the Upper North Shore. And, we're not sure how we should price a property. Should we just take off what the median is, dropped about 7%? Should we take that off last year's price? And that's unfortunately what a lot of people do, right? Is that sort of level one thinking. And it's causing a real danger at the moment because, they could be overpricing the property, or they could be, paying way overs. I guess it's the same thing. So I wasn't going to sort of go here as well so early on, but I mean,
let's go there.
Around vendors, right? Like, obviously human behavior is going to shift dramatically, both buyers and sellers. But how big has the shift been from what, say, the start of the autumn campaign, March, to what the conversations are in August, and listing your property? How big is that shift? What's changed?
You're saying from a percentage or just a general sentiment?
No, just from what the vendors are thinking. Like their attitudes has just got done a huge backflip.
Correct. Yeah. So we are in absolute downward spiral. Look, the media, in some ways, whilst they can be sensationalist in the way that they go about their reporting, what we can pick up is the trend line is typically correct, right? So the market is going down. So it might not be as dramatic or as swift or whatever they might be saying in the media, but generally we can pick up on the trend line is, so when we're sitting with a vendor, most of them now are reading the press and everything and they're going also and attending local auctions and attending other open homes in their market. And they're seeing now that a lot of things are lagging. They're not selling under the hammer, or they're sitting on the market for much longer. They're also seeing a lot of price reductions. So most of our conversations with our vendors are fairly clear. I mean, we work in a fairly commercial type of market where most people are astute. And I think this is probably more Australia broadly, that everybody, it's a bit obsessive how people treat property in each markets around the country. So most of our clients now are very much aware that things have changed. What they're not acutely aware of, well, how much has it changed for my specific property? And that probably gets to your point about the different segmentation. And each micro market in each area is going to have its different kind of outlining, what's doing well, what's actually struggling. And that's where I guess people get a little bit lost from a vendor's perspective. So I think overall, the general sentiment is we understand things are falling, but we're not sure how much that's impacted my specific house.
Now, this is quite interesting because you talk about falling, and I've been tracking some sales of properties that sold last year in your neck of the woods, and in fact, some of them by your agency, right?
Yes.
And so at least two of the ones in my list have sold twice in the roughly 12-month period, maybe give or take a few months, but certainly sold in 2021 and on sold this year. Every single property that I've tracked, that I've found, it's not that I'm only tracking the ones that have made gains. Some of those gains haven't kept up with actually market movement. So the market has actually moved faster than those properties have gained. But every single one has had a gain, which sort of goes to that C grade, B grade, A grade thing. There's the A grades would have had more of a gain than the C's and so on. But you're saying prices are falling. However, those properties haven't fallen in price.
Yes.
So how are you measuring that prices are falling?
Yeah, well, I guess what you're looking at is probably some anomalies in the market, and we're always seeing that at the moment too. Like there are, again, certain segments which are still performing quite well, and that can come down to sometimes, in some cases, luck of the draw if the right buyers in the market at the right time or the right set of competition. I know the ones that you're mentioning that we've sold, and the expectations of the vendors were that it wasn't going to get a gain. Therefore, the guides that we brought those properties to market were below what they paid for last year. Now, that's very palatable from a buyer's perspective, right? So, and I guess that's playing the field to a degree. Like every buyer that we talk to right now, the opening dialogue is maybe I should wait. Things are going to fall further. So, if you're bringing one of those properties which traded 12 months ago to market at a price guide that's higher than what the vendor paid a year ago, you're going to have a very tough time bringing a buyer even into the property. They'll just think, oh, they're crazy, So I think the ones that we're looking at, and maybe it's a bit more acutely aware for that seller bringing their home onto the market, that they kind of say to themselves, well, we understand things have shifted. We need to be a lot more aggressive on our guide price in order to reflect what the buyer pool are probably going to say when we come to market, and eliminate all those questions which come up like, why is a vendor selling in 12 months' time? What happened? Do they not like the house? And so then there's all these other things which unravel with that, as you know, Veronica, that you need to address that. And the best and easiest, clearest way to address that is coming onto the market with a price that people go, okay, I can assess that. They bought it for 3.8 and now the guide's 3.6. Okay, well, that makes sense. I assume they've taken that off, and let's at least go down and have a look at it. So,
and then it sells for 4.255.
Yes. Yes. But again, look, you're dealing with two buyers at that time, and some sellers are. They're fortunate, as you would know. They had two people in the market at the right time, at the right price, who just missed out on other properties and had been looking in the market through the course of last year. So, they would still had a little bit of that hangover of like, we just want a house. And if we have to pay for it, we will.
And so that's fundamentally what will lead people to still transact in this market, isn't it? That they have a need and they will just go for it, and because they find the right property. But it is interesting because this wasn't where I was going to take this conversation. I mean, Chris and I often have different goals in these conversations because we're both curious, but we are curious for different things. But this is an interesting topic around what you quote. Right.
Yes.
And I get that this is tricky because there's legislation around this. And if you've given the vendor an expectation and put that on the agency agreement, which you've obviously got to substantiate with market knowledge and also recent sales, et cetera, and the vendor's got to agree to that, blah, blah, blah. But it's also strategic. You also recognize that even if you think they're going to get what they paid, you have to quote less than that in order to get what they paid, and the legislation allows for 10% margin on that. So then buyers are then trained to expect agents to underquote. Do you know what I mean? And then buyers are it's a big sticky,
it's
messy
a game.
mire.
Yeah.
It is a game.
Correct. Yeah. Well, look, I think the reality is buyers aren't particularly trustworthy either. So I guess it's they will never tell the vendor and/or agent what they're prepared to do, what they're prepared to pay. How far they'll go, how much they love it, and all those things. So I guess it's all just a bit of matchmaking to try and do it. And actually, this will probably lead into the point that you'll go, because we argue about auction clearance rates and what's the right rate and everything like that. And you'll say, well, look, I just look for the trend. So you'll say if Domain are reporting the trend is 55%, but even though we know it's going to get revised down to something else in a week's time, at least I know the trend line is that's accurate, and that's what I bank off. So I guess if everybody is bringing the home onto the market with the similar kind of strategy, well, then the buyer has some sense of reliability. Well, if that's the way it's done, well, then that's the way we operate. So, and within that, of course, you've always got that 10% variance on either way. You've got agents that are probably hopeless, that are too high, and then you've got agents that are probably a little bit aggressive, and they're probably coming in a bit low. But generally speaking, within that kind of 80% span is what most properties kind of come on, and the expectations for the buyer are normally, pretty much in line with what it's going to sell for.
So with the vendors at the moment, so you have this conversation, like you've got the vendors who have to sell, maybe it's a divorce or a death or something like that. So to me, that's just always part of the market, right? But it's not something that really changes a lot. Unless there's the global pandemic or something maybe. But the reality is there's also vendors that come to the market because they want to upgrade. Now, they don't have to do it now. They may want to do it years in advance. Maybe it's kids' schooling or maybe that's urgent. They're in an apartment and they can't really last another year with two kids, for example. So, and then you've got maybe the downsizers are sort of the opposite. They maybe don't need to downsize at some point, but they don't have to do it now, but they know they're going to get older, right? And they can't maintain the house. So that sort of marginal upgrader, the one who, could do it now or could do it later, how are they just really wanting to sit on their hands? Because, they are basically saying, look, I don't know where interest rates are going to be. Look, maybe I should. And the thing is, it's hard just to say, I'm going to stay and renovate at the moment because building costs are through the roof, right? So they haven't got a solution. It's either like, I can't really build because that's not an option. I don't really know where rates are going to be, so I don't want to upgrade right now. So is that what you're sort of saying, that you're really finding it hard to flip their mindset, because they're the upsure ones who should be in the market right now?
Yes.
Because the gap to upgrade is actually smaller.
Correct. Yeah.
And so is that what you're really finding? Is it a bit frustrating for the couple there that's got a bit of equity, they've got great incomes, they really need to upgrade the next 5 years, but they want that clarity around interest rates, and so they're just sort of sitting on their hands?
Look, without question, So there's that uncertainty. No one wants to make big decisions, life decisions, with such a huge array of volatility and uncertainty in the market. And it's not just rates. There's talks of recession and all of these things weigh heavily on people's decisions, particularly if they're aspirational and moving up. There's uncertainty around, different people's, and you'd probably see it in the mortgage game about how banks are viewing, varying salaries for different industries and things of that nature. So, look, you're right, and you're seeing that also. Again, talking about data lag, the data ebbs and flows with the number of listings coming onto the market. But I can tell you, speaking with Domain during the week, they're saying that all their metrics are showing that this could be one of the weakest spring markets that we've seen on record for quite some time. And I know within the core market that I'm working in, and Veronica would know very well, in Balmain, we've only got 22 houses on the market at the present time, which is quite low. And you can see there that that's probably the spiral of everybody just sitting on their hands. So we're seeing a lot of people out there looking. They want to feel aspirational and want to move forward, but with all of that uncertainty hanging over their heads, they're just not willing to make that jump or that leap of faith. But it's not just upgrading into that next house. It's then, well, what happens with my existing home? I need to sell that. What price am I going to get for it? How long is it going to sit on the market? And there could be variances at the moment between, they might be thinking they're getting $2 million, but it could very well be 1.7. And that punches a huge hole in your gap of your borrowing capacity when you might be upgrading to a $3 million house. So
I think that's so true, Matt. Fortunately, we haven't had any clients caught out in this. I personally was very close to getting caught out because the massive drop in borrowing capacity over the last 3-4 months, we're talking 20% plus for a lot of borrowers.
Yes.
And if you went and bought on a long settlement and tried to sell on a short settlement, and you did it on, what was realistic borrowing capacity figures, in say May, March, sort of April, May, and then bought on a 6-month settlement, or tried to do a bridging, or et cetera. People could really get sort of caught out. And even if they used a bad day sale price earlier in the year, very quickly wasn't a bad day. That was actually turned to a good day.
Yes.
And so it was, people trying to buy before they sell, which was a very good strategy really over the last few years, right?
Yes.
But in this market, I think a lot of them have been scared because they've just seen such a big decrease in their borrowing capacity, a big decrease in what they potentially could sell for.
Yes.
That they just want to sell first. And if you have to sell first, then you just want to sit on your hands because you're like, well, I can't find any other good properties on the market.
Yeah.
And I actually don't really want to sell in this market because, I'm not going to get a great price. So it's really sort of hamstrung the market. And I guess that aligns to what Domain's saying there, is that no one's really wanting to sell is because they're so fearful that they can't upgrade because they can't find a property and they can't borrow the money.
Yeah, all of that's contributing. Absolutely. Yeah.
But is that what they mean by weak? I just, that's what I wanted to ask. If Domain is saying it's going to be the weakest spring, do you mean weak in terms of listings? Okay,
listing volumes, yeah. So there's some markets which are down 30 to 40, even up to 50% in a typical spring market. Yeah.
And we did it on it with Kent last week, a Best Streets report, and Veronica and I were like, anecdotally, in hot markets, a higher portion of good stuff sells,
Yes.
And in down markets, that good stuff, evaporates and more poor stuff sits on the market. And, you said there's 20 odd properties in Balmain, and this would apply across, a lot of our capital cities. But what do you have any idea of what number of those properties have been on the market more than a couple of months? Like, is it
only a small percentage, thankfully?
Yeah.
So again, like this is possibly, and this is where it gets so tricky as a consumer, is at the moment. So, and we're seeing the property market almost at the present time, like the share market, it's ebbing and flowing on a week by week basis. And that could largely, God bless the Queen when she passed away, but that absorbed so much media attention, everything like that. It almost gave us a little bit of reprieve for 3 weeks where it wasn't property headline. And I know it sounds crazy, but, I think we spoke about sentiment is such a major driver of people's decisions. And when you kind of drop off the front page of the paper, then all of a sudden people are like, oh, they get lulled into this. Well, we still got to buy, we still got to do this and everything like that. And I don't know, a little bit of confidence started to return for us. But, you might get another 50-point increase in the October reserve meeting. And then it's back to, we're back to seeing 20% price drop. So
one thing that I've experienced and been quite surprised of around this downturn is that open houses are not like ghost towns.
Right.
Every other downturn I've been through, honestly, you could shoot a cannon through these houses, you wouldn't hit anybody. Whereas I think there's a latent interest. They might be sitting on their hands, but there's certainly interest in the property market at the moment. And what are you seeing at open houses? Are you experiencing the same thing that I'm observing?
Absolutely. Yeah. So that's one of the key things that we're saying to our clients that are on the market at the moment. We're saying to them, the good news is that you're seeing people through your door. So that means we've got a chance to sell. And if we're not getting engagement, well, then we've got an issue with price. It's not the fact that we're not drawing in an audience. There's no inquiry. There's no foot traffic at your open. We're clearly just not aligned on price. So there's an adjustment there. And again, what we're seeing with most of those properties, if that price is adjusted, we're then securing a sale within the next couple of weeks of that property seeing the price drop. So I think that's the key thing in this market. You're right. There is definitely interest. Now, I'm not sure if that's a hangover of seeing one of the largest price increases that we saw ever, or what it might be. But there's definitely people out there that are now thinking, well, if I can pick up that house that was selling last year for 3 and it's now 2.6, I should be paying attention to that.
But as we've just talked about, so far, the houses that have sold last year and then on sold this year haven't sold for 2.6 if it sold for 3 last year. So that is once again, perception is not necessarily reality. What I'm interested in as well, and obviously you're having these conversations with vendors, and obviously you're observing that they're reticent to put their property on the market if they're not under pressure to sell, or life hasn't got in the way, or they haven't bought something else. Then why would they? You'd wait, right? And it's sort of interesting because in a seller's market, sellers don't typically wait. They go, great, gang, go to market, yeehaw, I'm going to get my price. Whereas in a buyer's market, everybody seems to wait. So it's like seller's market, everybody's in the fray. Buyer's market, everyone's sitting on their hands. And so but we've still got Sydney-wide, we've got clearance rates, whether you agree with them or disagree with them, sitting, and I'm talking about domains because that's one I've tracked for years. And I do look at trends, and I look at trends of withdrawn listings and clearance rate, and also I sort of track the actual total amount of listings. That's even quite an interesting chart, just looking at the listings volumes over Sydney, because you see the seasonality play out, and there's a volatility that happens around that sort of Easter to May period. But currently, and for the last, say, about 6 weeks, there's been very, very slight trending of clearance rates up and a very, very slight trending of withdrawn properties down. And so that's really interesting at this cusp. We're recording this sort of at the end of September. We'll go live in October sometime. That's quite interesting data to look at in this current time in the market, because what normally happens at this exact point in the market is usually the peak. If a market's going to grow at all during year, usually it peaks at the end of September in Sydney, and then it falls off as lots of stock comes on in Sydney and saturates the marketplace. But if we're talking about really, really tight listings activity, so the only stuff that's swelling out total number of listings on the market in Sydney, it is basically the C-grade stuff that's struggling to sell and blowing out in terms of days on market. Then it's going to be interesting to look at that curve and what happens in terms of clearance rates and the withdrawn, because the number or the percentage of properties that are withdrawn from auction, that to me reflects agent and vendor confidence.
Yes.
If you're confident, you're not going to withdraw the listing, are you? But when it pushes up towards 20% of all listings are withdrawn, then that's showing that there's not a lot of confidence. There's, that sort of gives a sign as to what's happening behind the scenes, because of course agents don't let buyers know really how many people are interested in the property before auction. Oh. But that's a bit of a tech giveaway.
No, that's right. Yeah.
So back to where there's a bit long-winded entree into what my question is here. So if 60% or thereabouts clears at auction, right, on any given Saturday, what do the 60% have that the remaining 40 doesn't have? What is it that makes a property under these market conditions sell at or before auction that is lacking in all the others?
Well, I would have to say it just comes simply down to price. I think this is a value-driven market at the present time, and we know, like our experience is at the present time, even if we get the guide price off by 5%, might only be 5%, and that can be very much the differential between the right people coming through the door or the wrong people coming through the door. And again, even though it is a cooler market, we're still finding in the first week or two, are we on track or are we off track? And that's still happening quite quickly. The same as it was happening in a hot market. But the differential now is if you're off, then you could be well off. And that's the thing. Whereas you could kind of mask it in a hot market. If you're off, you're like, oh, it didn't matter because it was going up anyway. So your conversation with the seller didn't matter. It was like, oh, we told you 2.2. Don't worry, you're going to be getting 2.4. So it didn't matter. But now it's like, oh, we told you 2.2, but you could be getting 1.9. So the differential is that it's taking a longer period of time for the vendor to reason with the feedback that they're hearing from the market, because they may have been told by an agent or us, 6 months ago, oh, look, we think we can get 2.2. They hang on to that number. And then when we come into market, it actually turns out it might be 1.9. So it's just, I think the differential is it's just taking some vendors a longer time to kind of digest and dissect all the information that's being provided to them. And some of them we know, and you would know as well, some people they just don't want to listen to reason or feedback. And they're just like, I've got a number in mind and I want that number. And a classic old line that we say, and we get told it all the time, and I'm not giving it away. I'm just definitely not going to give it away. I'm not
just rent it out.
This. Yeah, I'll just rent it out. I'm not fire sailing my house. It's like, well, hang on. I'll give you 2 million reasons why it's not a fire sale. It's just that the market. And unfortunately for some sellers, the reality is, and I know it sounds a cliche, but it's an old quote, but the market is absolutely worth what somebody's prepared to pay for it. Now, if you've done all of the controllables correctly, i.e. you've got the right marketing campaign, you've had a broad audience come through, the house is presented perfectly. If you've aligned all of those things and the market feedback isn't there, well, the market feedback's not there. It's not a problem with your expectations. It's you've got to adjust. That's the issue.
I think what we're saying is that those clients with those properties where they, are frustrated with the sale price of what it would sell for today. And, we've all got this loss aversion. We're all doing this mental accounting where we could have sold it for X last year.
Yes.
What I'm trying to do is open their eyes up to what the opportunity is, right? Like, This isn't trying to sell loans at all. This is trying to sell them to make something, taking action on what they need to do anyway, and getting into a better quality asset. Because, you take a haircut on this property, but what you're doing is buying in under much better buying conditions. You're not got, offers getting made the same day as opens. You're not having to go to auction at every good property and then just throwing down the biggest number, right? You can actually try to play this game a little bit smarter and potentially, if you are patient, get a quality asset at a fair price. Whereas, in the last few years, that's been really difficult to get anything good. So, is that something you're trying to have that, lingo with some of your sellers is that, yes, you can sell this property for less than you got last year, but at least you're in the market and you can potentially compete on, doing an upgrade. Is that going down like a lead balloon, or are you finding that, some people are switching on? Because once people understand that, that they can make this move, and if they wait till, next year and then all of a sudden they've got competition and there's low listings and then they start chasing themselves. So is that what you're trying to do as well?
Absolutely, mate. Yeah, but what you're saying there, Chris, is common sense, right? And so when you're dealing with property, there's emotion, right? So that's the wild card in all of this. And as you rightly say, like there's an amount of people that sit there and go, hang on, I need to get this certain figure because then I can go and get a car, and then I can have a holiday, and then I can send my kids to school. And there's all of these kind of metrics which sit behind the scene, as you're rightly saying, they're going through their mental accounting. And common sense isn't so common in our game, sadly. So we deal with, and this is where the data is often wrong, that it relies on the facts and figures, but it misses that vital component, which is sentiment and the wild card of emotion. And that's why, property is such a tricky thing in terms of valuing and the consumer experience and how agents operate and how vendors operate, and everything. But to get back to your point, absolutely, we're sitting with our clients now and we're walking through the process. Why would you not be upgrading now? To your point, you've got less competition on the market. You can get better terms. You can probably get a longer settlement.
Yep.
You're definitely talking a better number that, and we'll demonstrate to them. Last year, a like-for-like asset might have been 20, 25% more than this. Why would you not be engaging this? You were happy to go last year. The only thing that's been changed at the moment is your interest rate's gone from 2% to 5.5%. Yes, we understand that's a difference, but it's been factored into the buy price. The other thing that we're often doing as well at the moment is we're talking to a lot of our clients who are saying, I'll just hold it for 2 years. I'll come back when the market's better. I'm like, well, then we'll demonstrate to say, well, look, if the market drops another 10%, which is probably a conservative view of what's unfolding at the moment, but if it does drop back that 10%, to get back to parity of where we are today, you're going to need that market to be rising by 15% or more to get you this number that you have in your mind to then make the transaction. But by that stage, the house that you were looking to get's also gone up.
Yeah.
Simply so it's difficult, but this is why things are taking longer to sell. So a lot of our campaigns, going back to Veronica, we're instead of doing our typical 4-week auction campaign, sometimes we're now doing 5 weeks, particularly if we've got a vendor that their expectations, we know they might be bullish. We might say to them, look, okay, we're going to need a little bit more time here. We're going to have to go off market for a week. We're going to have to come to the market with a 5-week campaign. So that way we can download as much information and intel for this client so that they can kind of understand and absorb it all to then make that next decision to move forward with confidence.
If you like what you're hearing here, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars, please. Every review helps make it easier for other people to find us and hear what our amazing guests have to say. We love hearing your questions and we're planning more listener Q&A episodes. Please send your questions in. You can send them via the website, which is theelephantintheroom.com.au, or directly via email to questions@theelephantintheroom.com.au.
Do you find many vendors are regretting not taking offers? I mean, one of the things we're just sort of talking to clients and I'm saying, look, they all sort of want to see what's happening, et cetera. And it's like, well, no, the hard thing right now is actually getting a quality asset, right? Like you need to get your focus around that and being patient, because if it's not a quality asset and the market continues to go poorly, then you're going to get smashed, right? And so you've got to buy quality. But, the real advantage right now is speed, right? Is to make a solid offer that's around what the vendor wants, because it's gutsy to say no, and you sort of, when you get that good solid offer on the table, it's pretty close to the right terms to what the vendor wants. A vendor is really hesitant to say no to that because they don't want to be that, 4 weeks later saying, oh, I wish I took that offer at 2.1. I can only get 2 mil now. Is that sort of what's happening?
Yeah, for sure. There's plenty of case studies around all of that. And most agents in every market around the country would certainly be aware of those case studies and pointing them out to those clients that held out. Oh, just hold out for the next offer. And quite often, to your point, like even though it is a cooler market, some of these best offers remain to be coming through in the first week or two. Yeah. And you have to be really setting up your vendor to saying, hey, look, don't worry about all the news and headlines, the market cooling. The right buyers are out there and they'll come and engage in your property straight away. But as quickly as they're there, as quickly as they'll be gone. Yeah. So you've got to engage with them very, very swiftly.
One of the issues, though, with sort of encouraging people to upgrade, particularly if the conversation is around selling first, because it's a fairly logical way to approach the dilemma of do you sell first or buy first, is to look at which is hardest and do that first. So in a market where it's really difficult to find what you want, you're more likely going to buy first, as long as you can fund it. And in a market where it's going to be difficult to sell, you're more likely to sell first. And then go out there and buy, right? The problem is, of course, in this sort of conditions, we're saying that it's really difficult to find good quality property because listings are shrinking, and it's also difficult to sell. So you sort of can understand, I'm now being devil's advocate. Logically, I totally agree with you. The transfer pricing or transaction pricing cost is lower to upgrade in this sort of market conditions, as long as you can find the property you want to buy, than it is in a booming market. But in a booming market, you're probably going to have options, but then you're going to have a hell of a lot of competition and probably have to pay massive overs when you get to the point of finding the one that you want, particularly if you've sold. So there's all these sort of pressures within that timing and working out how you move through that. And that is obviously going to be a challenge in those conversations. I imagine a lot of vendors go, but I can't find what I want, particularly on the Balmain Peninsula, as I know it very, very well, and people won't leave it. I'm a testimony to say there is life off the Balmain Peninsula, but
don't spread the word.
I'm a rare voice.
Well, they can't fund it at the moment, Veronica. That's one of the ironies, is that it's very hard to buy and hold on to your current assets, because borrowing capacities, let's say you could have, borrowed $3 million last year collectively on your portfolio. Well, that's now only 2.1, or 2.2. And you've already got $1 million of debt. So to do that upgrade, it's just not possible anymore. And that's another thing that's really stopping people doing anything, is that the only option is to sell first. And then that's too scary. So, what are you going to do? You're just going to sit on your hands. And so, I mean, do you see any real sort of change here at, the downsizer segment at all? Are they just wanting to sit on their hands as well, Matt?
Yeah, so the downsizer segment's pretty interesting. They're probably our most bullish part of the market at the present time, because they've got other assets. They're just looking for the right property, as opposed to, worried about if interest rates go up another 0.5 percentage point. They understand that, but they've got time, right? So, and this actually raises the question, when you see those good quality assets, a lot of the downsizers are identifying those because they're accustomed to a reasonable level of lifestyle. And so when something comes up in certain markets that they go, this is a perfect house, they'll outbid a lot of these people which are actually under these more restrictive borrowing capacity. So that like we're saying to a lot of our clients now, if we can corner that downsizer market, if you've got that right property that's going to get that broader, like you might have young families, professionals, but if you get the downsizers, you're actually in a much safer position now to get a good outcome. So Yeah, they're out in force. No question. The downsizers, they see this market as, it's ripe for the pickings in many ways for that. Because again, even if they take a little bit of a haircut on their existing asset sale, they're okay because they're looking longer term. They're going, look, I'm just looking for the house that's going to suit me for the next 10 years. Minimal stairs, close to the shops, got a car space, fantastic. I'm in. I'll pay a premium for that, and I don't mind taking a haircut on mine because that's the house that I want for the next 10 years.
Yeah, and they've got no debt on their mortgage, right? So what interest rates are doesn't really matter. If anything, it's actually better because it means they get more money on their cash in the bank, and so it's not a bad place for the cashed up baby boomers. Matt, if you had to say H2 2022, through experience, you start to sort of in your mind think, oh, that was actually similar to what it was in 2018 or what it was. What would you say it's most like? If you've been in the game a long time, what would you sort of say this period right now is most like?
Well, so 2018 was a pretty flat year, it's when we kicked off this podcast, right? I remember the market being quite flat. I think there was the APRA stepped in and lifted the serviceability rate, and that actually cooled the market. I actually find that was, in some ways, I think Veronica alluded to it earlier, you could fire a cannon through open homes. There was nobody looking because the serviceability, it was just too scary. It was just like, hang on, I can't even get my finance. Whereas now people still can get their finance. It might be more restricted. They might be getting 20% less than they could have, even at the beginning of this year. So I would say what the differential. I would say it's close to that market in 2018. It's close. It's got elements of the GFC part of it as well, when there was the volatility and the uncertainty in the market. Okay. But what's unfolding right now is the rapid speed of these rate increases is impacting the price declines. Well, I mean, the data is also showing this, right? It's the fastest and sharpest price declines that we've ever witnessed. And that's the tricky thing that we're having with our conversations in lounge rooms is, we might be telling a client a price, but by the time we come to market, because they've got 4 weeks worth of prep work and cosmetic detailing and all that stuff, by the time they come to market, we've got to have a whole other conversation that might be 5-10% below where we told them only a month earlier. So, I think there's elements of 2018, definitely the volatility of the GFC and the uncertainty there. But what's unfolding, I guess, this interest rate environment is quite astonishing, and the narrative in play that, I think the terminal rate for the cash rates got lifted again by most institutions just like in the last 24 hours, where I think most banks were saying it could be somewhere between 2.8 and 3.1. I think CBA was saying 2.8. I think they're all lifted that up now to 3.6. So you tell me, translating that into an interest rate, is that mid-fives at least?
I mean, for our listeners, a good way to think about it is just add 2% onto the RBA rate, and that's what you should be paying on your home loans, right? And then maybe add another 50 basis points, whether it's interest only or investment, etc. It's probably not even that much anymore. But, so it's 2% on top of the RBA rate. It's probably a good home loan rate, and up to 2.5, for investors, etc. So, if the RBA gets to 3.5, then that's a 5.5% interest rate on your home loan. But what then
a serviceability rate on top of that,
Well, that's it. And so then you go add 3% on top for the RBA, the APRA sort of serviceability buffer. So 5.5 plus 3%, that's 8.5. That's about a 3.5% increase to the serviceability buffer from what they were offering last year. And every 1% increase in the serviceability buffer is about a 10% reduction in borrowing capacity.
Correct, yep.
Let's say a 30 to 35%, 3 or 3.5% increase in the serviceability buffer is about a 30 to 35% reduction in borrowing capacity.
And that's going to translate to property prices.
Absolutely.
Sure.
And I think APRA, slow the market down, but they're also going to have to step in, to say the serviceability buffer can't be 3%. So I reckon that's going to have to happen. But you also said we're seeing wage increases, even today. And this isn't, so if you've got a 15%, increase in your salary, that's going to offset the reduction in borrowing capacities. And, part of this inflation cycle is that people are asking for more money, right? And especially if you're in a talent shortage with low unemployment. And so that's something that's obviously forgotten about, I think, for some people, is their borrowing capacities have gone back up just as much because they've swapped jobs. And they're still buying at the same price point. So, there's obviously lots happening.
Yeah, there is.
Matt, there's been some, despite all this sort of talk about how tough it is and all the rest of it, to put on my old real estate agent's hat and go, you know what, been here before. It's not like, come on, like really you got a bit lazy in the good days and come on, just earn your money. I know a lot of the younger agents out there, it's like their eyes are bigger than they're just like rabbits in headlights. They actually do not know how to deal with these market conditions. But this is like the old thing about a normal market, right? Good properties, well-priced properties will find their buyer, and anything that's overpriced or it's not that great is going to, main road properties aren't going to fly out the door in these market conditions. This is sort of just normal. And it's roughly balanced. Every property's got a buyer if you got the price right. So, ultimately that's just getting the job done. But there's still be some pretty amazing individual results. So certain properties that might surprise us. I mean, there was one particular property, I won't name the street, but you probably guess it sold for $8 million. It was highly competitive. It was renovated within an inch of its life. Like basically the finishes are what sold this house, but obviously, that's not going to last forever. And I couldn't have thought that it would get to 7. I honestly couldn't, that there was actually it's not a very big house, and it's in Balmain. And yet I think there was something like 8 registered bidders, and then they've sold it at that price, which was ahead of expectations, but, very competitive. And I know there was a wild card thrown in at the end, all that sort of stuff. But that sort of outcome and that sort of story, and even the wild card rocking up, without the agent really knowing they were interested and buying it, all that stuff, that's the story of hot markets.
Yeah, for sure.
So these sorts of things happen even in a slow market. You'll get these outrageous results that are well and truly over and above expectations. And I honestly don't think it's a great property. I really do think they overpaid. But, we couldn't encourage our clients to go for it for lots of reasons.
Yeah.
But these things do happen, don't they? I mean, so I guess what I'm trying to sort of get to you is to talk, give us some of those stories. Not that I want to talk it up, I don't. But it's just that because there is so much negativity out there, it's like there are still people out there that go, who cares? I'm gonna fight for whatever I want.
Oh, look, for sure. Look, there's always somebody who wants to buy Porsche. There's always somebody who wants to buy Ferrari. There's those things. So the cream rises to the top in any market, as it does in sporting or anything like that, under pressure. So that's what we're seeing in this market is the cream is rising to the top. Buyers are more discerning, and they feel like they've got time to pick the eyes out of, if I'm going to do something in this market, I'm going to wait for the AAA plus stuff. And if that comes up, they'll go all at it. And they'll go borrow big, but do whatever they can if it means selling an investment property or selling some shares because the AAA grade properties come onto the market. Well, they'll do that. And so to your point, the market's actually not. It's moving and it's shifting and it's volatile and all of those kind of things. But yes, we've got to buy for every property. And if you've got something which for your market, wherever it is in the country, that has those AAA attributes, and it doesn't matter if it's a 2-bedroom, but it's the right layout with the right aspect in the right street and all those kind of things, through to your 6-bedroom mansion with a pool and everything like that the market wants. I mean, every agent and every seller will know if they've got the best of the best when they come into market. You will find that there is competition. And people will go, and surprisingly will probably go harder at it because, well, again, in this softer market, that stuff's becoming rarefied to come to market, because the only reason why those people are bringing their home onto the market is because they've seen something that made them attracted to move. And so therefore you've got fewer of these things right across Sydney. Doesn't matter. I talk to agents in the east, the lower North Shore, right across the inner Sydney, basin. And most agents are saying, if I can get that AAA stock, it will fly. But there's so few of them. And that's probably magnifying the reason why we're seeing such good competition for those still.
And probably why you're finding it tougher. Because if you've got a smaller proportion of that type of property coming onto the market, that means every deal you're doing, you're working harder for. Because they're all harder to deal with, those properties.
Yeah, and it also comes back to an initial point that we were also talking about, which was, why would you be a buyer that would wait? Because, we got a lot of people that miss those properties, and then they pack up their suitcase and go home and go, well, we're going to wait for the next one. And you go, well, hang on, here's something that's marginally off that. Maybe you need to spend $200,000 to get it better to looking like that. Or maybe it's not quite that street, but it's pretty darn close, right? You might have to compromise one or two things, but why wouldn't you go for that knowing that the next time that AAA comes up, there's going to be 10 people bidding it. You've got a 10% chance of getting it again. So it's just very difficult for people to kind of digest all of that, and maybe it takes a bit of time.
Well, I think that's the irony, isn't it? What are you waiting for? Like, is it a certain price? Like, it's like when shares, we've got this anchoring bias, right? Or we've got this, we hold on to our losing shares just because we don't want to lose money, or etc. And so everyone doesn't really they haven't really thought that many steps ahead. Like, so yeah, I'm going to wait, but when are you actually going to buy? Like, are you just going to wait forever? Are you going to wait till prices fall 20%? Are you going to wait till there's less properties on the market? Are you going to wait till you go to open homes and they're busier? Like, what are you waiting for? What's the trigger point? And I think a lot of people haven't thought that through. Really, what you should be waiting for is the right property, right? And having a crack at it. And and obviously making sure you can afford if interest rates go up, and make sure you don't doing silly and buying before you're selling, and settlement risk and all this sort of stuff. But obviously, you're not just waiting for everyone else, the herd. And then once the herd starts running, and then all of a sudden you start chasing your tail, and then all of a sudden you've just missed the window, and then you start chasing yourself. Like, we had lots of clients who missed the window in 2016, 2017. They just ended up having to rent, or they sold, and then they sat out of the market for years, and then you end up just chasing, and then you have to move regionally, etc. So you just got to also sometimes people don't understand the risk they're taking by waiting sometimes.
Big time, yeah.
And what it creates. I mean, Matt, I wouldn't mind talking about just the real estate industry. Good days, 2020, 2021. Obviously it was a bit scary 2020, but I mean, price increases, more supply coming on, easier to sell. I mean, what do you think is going to happen over the next couple of years? Do you see a massive consolidation? You look at some of the biggest real estate agencies, their share prices, they're pretty dismal.
Yes.
And you see a reduction in number of agents. Are you working harder now than ever? Like, is this what really where the shine? You really got to. The good agents will just keep on getting better market share. Is that what you think is going to happen over the next few years?
It feels that way, yeah, for sure. I mean, look, you can't do it all on your own now, and the level of service and expectations upon agents is growing exponentially year on year. And that's good. That's good for the industry and people's expectations about how we deliver service and things like that. I mean, we've become, I guess, over the last decade, full service in terms of when somebody comes to us and says, I'm bringing my home to market, we're saying, great, okay, well, we'll manage your storage, we'll manage your styling, we'll manage your painting, we'll do your kitchen up, we'll do, so we've become, mini renovators in some respects. And all of that goes on behind the scenes. So at any one point, we might have, 15 to 20 houses that are under construction coming to market, and that can vary from, $5,000 to $100,000 in prep work to bring it to market if we think that's going to deliver the right return for the client. I can see that. I know within my team, my personal team, we can't do all of this stuff. We can't follow up. And the volume of inquiry that you're getting now is exponential as well. So you can't get back to everybody. You can't service the number of buyers. We can't keep a hold of all of this data unless you've got a whole team running behind you. And technology will only take you so far too, right? So all of the tech players out there, you've seen a lot of it in the prop tech space. You probably have a lot of them on your podcast. They promise a lot. They deliver and execute poorly in reality. So it's very difficult to find anything that's giving us the real cut through of like, oh, this does all the AI and all that. I mean, there's a lot of promises out there, but really, I can tell you it's still hard work on the phones, doing all of these things, face-to-face meetings. It's probably doing all the same stuff that, Veronica and I were doing 20 plus years ago, times 10.
The prop tech plays crack me up because I listen to the prop tech podcast in spurts because I get annoyed sometimes by the perception of what the problem is that they're trying to solve. It's like, oh my God, it's so bloody textbook. And it's like they're trying to solve an honesty problem or a trust problem or a transparency problem. It's like, that's actually not the problem, and it's because it's not only agents that are lying. Everyone lies, as we talked earlier. Yeah. So it's like, it's bullshit to come with some sort of solution that fixes one of the three aspects to the problem, But it also makes me laugh too, because at the end of the day, it's a very labor-intensive business. People don't like to have a bot giving them the answer to their questions, or that, they really don't enjoy that. And it's so, and they also only want to talk to you as an agent when they want something from you. They don't want to talk to you when you want something from them. So it's a very unbalanced industry when it comes to the human relations of it all. So that's why I laugh at those prop tech comments, because it's like all these smart, clever people in their technology, and it's like they fail to understand that really the human behavior at the core what's driving everything in the property market.
And also people's timelines, like it says, oh, look, we'll set you up and we'll put you in this system that we contact you once on the first of the month, every month for the blah, blah, blah. But, they get divorced. And that
happens on week 3.
That happens on week 3. Or something happens, or their finance isn't approved. Oh, well, that 6-month plan that we had for them is now a 3-week plan. So it's very difficult. And what I've discovered, the deeper you go into this industry, and it's great that our CRM and stuff like that can run a lot of this stuff, but really, people want to talk to people that make common sense, give them good advice at the time that they need it, and just there's no bullshit in between it. It's just straightforward talk.
Yeah, absolutely. I mean, you can see it if you look at some Open Door in the US, it was a $30 US share price. It's $3 now. So that was one where, we'll buy your home for any price. We'll renovate it and we'll sell it and we'll flip it, right? In a hot market, absolutely. They can make some money and holding it for 6 months. In this market, do they want to take the risk, so the share price crashes. I mean, a lot of the prop tech stuff is suitable in some markets. It doesn't work in a down market. We had a lot of did a bit of consultancy around lots of mortgage tech stuff, and low deposit home loans for first time buyers. A, the banks don't need that business in this market, and B, by the time they've got their products ready, no bank wants to go near it because it's market's falling and a low deposit home loan is the highest risky thing, right? So it's I think all the prop tech stuff, it forgets that it's humans at the end of the day that people really trust in both markets. They want good advice and trusted advice. And so the real professionals really sort of shine. So thanks so much for coming on, Matt. I do think it's a conversation that people need to have right now. If you're a seller or if you're a buyer, is just forget about the media headlines, etc., and start getting back to your situation and what's the right next move for you. And start taking action, really, or getting ready to take action, at least making decisions on your timeline and what your next decisions are going to be.
And be careful who you get advice from. Because there's just so many fairly recent entrants into this market and I hear some of the stuff, like, how can you possibly predict what's going to happen? Like I was talking to someone who said, oh, my agent told me next year this is going to happen. I'm like, nobody knows. Like we do our annual report, fool or forecaster, because basically everybody who's a forecaster is a fool. It's like, don't listen to someone who tells you they know what's going to happen. They can talk about patterns. They can talk about, experience what's happening on the ground now, what might transpire, what normally transpires in a market. They can talk about all that, but no one can predict. So I think if you're talking to anybody who is actually telling you, oh, this is what's going to happen next year, then you better get rid of them and go and talk to somebody who's a bit more pragmatic.
Oh, and I would say get on the ground. What you were saying, Matt, about, if you get to an auction in your area for a property that's similar to yours, and go see how busy it is, and go to the open home and see how much competition was there. And, rather than read the newspaper, that 15 minutes would have been much better just going to an auction up the road. And maybe you just walk home with a big smile on your face and go, oh, God, maybe things aren't as bad as I thought. Or maybe things are,
that's right.
At least you know what's happening in your market, not what's happening in Adelaide.
Absolutely. And that's our advice to all of our clients, which is that, get out and about, go and have a look, talk to some of the agents, prepare yourself and to control the controllables, which is making sure if you are coming to market, look after your own home, look after all the things, have a look at the trends of what people are looking for in your market and try to deliver your home that appeals to the broadest group of people possible. And then that's why you're setting yourself up and ensuring that, when you do come to market, the best outcome is there on the table for you to get it.
One final thing, Matt, I know you got to go, but just getting the properties to market, you said you got 15, 20 properties or whatever that you're preparing. That was a lag for, getting those trades, getting the painting done, 2020, 2021, 2022, you find it a bit easier to get them all booked in and get the materials through, or is it still the same? Oh,
yeah, the trades are actually pretty good. There was definitely a blockage. I would say maybe 4 months ago, where it was like, just don't call me. And it was probably after the heavy rain we certainly had here on the East Coast, where it was just like, get a roof. I mean, all of our houses, we work in an older area where damp is a major issue, roof leaks. I mean, we had brand new houses which had sprung leaks, so such was the rain that we had here on the East Coast. But now I've noticed it probably in the last 2 months, that getting trades, they're actually starting to go, oh, hang on, we might need some work coming up. So, and some of them I've heard have been, like they've taken advantage of the bullish narrative in the media, which is, oh, costs are going up. And they're probably adding another bit of GST on top of the actual real cost. So they're pricing themselves out of the market all of a sudden.
Interesting how volatile that can be.
Yeah.
Thank you so much, Matthew.
Great to see you both.
Thank you so much. And good luck for the rest of spring.
Same. Appreciate it.
See you around, no doubt.
If you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or North Shore, my team and I can help you buy without regrets. Reach out via my website, gooddeeds.com.au.
If you're looking to buy your first home, thinking of upgrading into a new one, or purchasing an investment property anywhere in Australia, my team love to carefully guide you on this journey. And most importantly, get the finance right. Reach out via our website, wealthful.com.au.
Thanks for joining us. We'd love to see you again.
And remember, don't be a Dumbo.